Assalamualaikum warahmatullahi wabarakatuh. Hello fellas.
How is it going?
We hope you are doing okay.
Alright, we are from Group 4. My name is Ades Kurnia and my partner
Ivana Astitya. We would like to present about
input tax
and output tax. So, here we start. Happy watching!
The first sub-material will be explained by me about input tax. Input tax is a value-added tax paid by a taxable entrepreneur due to import of taxable goods or acquisition of taxable goods or receipt of taxable services or utilization of intangible asset goods from outside the customs area or utilization of taxable services from outside of the customs area. Here, the formula to calculate input tax is the rate multiplied by tax base. The input tax rate is 10%. The basis for imposition of taxes can be in the form of import value, purchase price, or the same as the selling price for seller, replacement value, and other values. Here, the example to calculate input tax. Taxable entrepreneur X delivers the taxable goods to taxable entrepreneur Y at the selling price of 210 million rupiah. Output tax for PKP X, 10% multiplied by 210 million, and the result is 21 million. Input tax for PKP Y, 10% multiplied by 210 million, and the result is 21 million. Value added tax of 21 million rupiah is an input tax for buyers or PKP Y, and output tax for sellers or PKP X. And next, we discuss about input tax crediting. Input tax within one tax period is credited with output tax for the same tax period. Input tax can be credited from output tax if it meets the following conditions. First, the input tax is directly related to business activities. Second, input tax on taxable goods and all taxable services is used for delivery that is subject to value-added tax. Third, input tax is accompanied by a valid tax invoice. And fourth, input tax that can be credited but not yet credited with output tax during the same tax period can be credited in the next period not later than 3 months after the end of the relevant tax period, as long as it has not been charged as an expense and has not been audited. And then, input tax crediting for taxable entrepreneurs calculation net income with loans. Regulation of the Minister of Finance on guidelines for calculation of income tax accounting for taxable entrepreneurs based on Law Number 7 of 1983 concerning income tax calculation as a taxable entrepreneurs understanding income taxes with a number of income taxes with 70, income tax in 2000, income tax with 17, income tax with a number of income tax. In this regulation of the Minister of Finance, what is meant by? First, taxable entrepreneur is an individual taxable entrepreneur who chooses to be subject to income tax by using the net income calculation norms based on Article 14 of Law Number 7 of 1983 concerning income tax as amended several times, most recently by Law Number 17 of 2000. Second, retailers who use the net income calculation norm are individual taxable entrepreneurs with a gross turnover and all gross revenue for the one financial year of not more than 1,800,000,000 rupiah, which in business activity or main job is to conduct trading business in the following ways. First, delivering taxable goods through a retail sales place, such as a shop, kiosk, or by way of sales made directly to the end consumer, or by way of sales made from house to house. Second, provide taxable goods delivered at the retail point of sale. And third, conducting sale and purchase transactions spontaneously without being preceded by a written offer, written order, contract, or auction, and are generally cash in nature. And buyers generally come to the place of sales directly carrying the taxable goods they have purchased. For a taxable entrepreneur using the input tax crediting calculation guidelines, the following condition apply. output tax is calculated by transferring the gross turnover value and or gross received payable value-added tax during the relevant tax period at the rate of value-added tax. Gross turnover value and or gross revenue as referred to in letter A doesn't include value-added tax. The amount of creditable input tax is determined as follows. First is 18%. For the delivery of taxable goods by retailer merchants using the net income calculation norm, the amount of 18% is multiplied by the output tax as referred to in letter A. Second, 17%. For the delivery of taxable goods by a taxable entrepreneur other than retail merchants, the amount of 70% is multiplied by the output tax as referred to in letter A. And third, 40%. For the delivery of taxable services by a taxable entrepreneur, the amount is 40% multiplied by output tax as referred in letter. And next, we discuss about input tax that can't be credited. Input tax that can be credited from output tax if it comes from acquisition of taxable goods or services before the entrepreneur is confirmed as taxable entrepreneur. Second, the acquisition of taxable goods or taxable services that do not have a direct relationship with the business activity. Third, the acquisition and maintenance of motorized vehicles in the form of sedans and station wagons, unless they are merchandise or lease. Next, we discuss about restitution. Overpayment of input tax compared to output tax can occur because the amount of input tax is greater than the amount of output tax in tax period because first, purchase of taxable goods or acquisition of taxable services made before the business started or at the start of the business. Second, taxable entrepreneurs carry out export activities of taxable goods. Third, a taxable entrepreneur delivers taxable goods and all taxable services to a value-added tax collector. 4. A taxable entrepreneur delivers taxable goods and all taxable services in connection with a government-owned project whose funds come from foreign assistance in the form of grants or loans. Tax collection errors committed by taxable entrepreneurs. The taxable entrepreneur made a mistake in collecting taxes, and the tax that was incorrectly collected was reported. Article 9, paragraph 4 of the value-added tax allows that if during a tax period the input tax credited is greater than the output tax, the difference is the exit tax that is compensated for the next tax period. Exit input tax can also be requested for a refund or restitution at the end of the financial year. In certain conditions, the excess of the input tax above, the output tax can be submitted for a refund at any tax period by a taxable entrepreneur exporting tangible taxable goods, and then taxable entrepreneurs delivering taxable goods and or delivery of taxable services to a value-added tax collector, and then taxable businessmen performing the delivery of taxable goods and or delivery of taxable services whose value-added tax is not collected. Next, a taxable entrepreneur who exports intangible taxable goods. A taxable entrepreneur who exports taxable services. And last, entrepreneurs are subject to tax in the pre-production stage.
We talk about output tax, but before we go to output tax, we have to know first the shortness of this chapter. First is JKP. JKP is jasa kena pajak, or BKP barang kena pajak. PKP is pengusaha kena pajak, and DPP or tax imposition base is dasar pengenaan pajak. Next, output tax. Output tax is payable VAT that must be collected by PKP who make BKP submission, JKP submission, and BKP exports. Next, for the submission of BKP and submission of JKP, the rate for output tax of these two is 10% for delivery of taxable goods within the custom area or delivery of taxable services within the custom area by taxable entrepreneur. So submission of BKP and submission of JKP have output tax rate multiple by tax base. Next is export BKP. For export BKP, there are no tariff for export of tangible taxable goods or export of intangible taxable goods or export of taxable service by taxable entrepreneur. Why 0%? Because government wants to increase the exports in Indonesia. We talk about output tax in VAT. Output tax in VAT or tax imposition basis (DPP) can be in the form of selling price, replacement, or export value. Before being multiplied by the rate, the tax base is a price or value that doesn't include VAT. So output tax in VAT is DPP or the real value of the selling price, replacement, or export value. We go to the example. Here, for example 1, taxable entrepreneur A sells taxable goods to customer at selling price 25 million. So, like I said before, VAT payable, the tariff is 10%. So, 10% multiplied by 25 million. So, the VAT payable is 2,500,000. Next example is taxable entrepreneur B delivers the taxable services by obtaining a replacement 20 million. Like I said before, JKP is 10% tariff. So, 10% multiplied by 20 million. We get to 2 million. Next, taxable entrepreneur export taxable goods with an export value. So, the first example is BKP, next is JKP, and then it's export goods. For export goods, like I said before, the tariff is 0. So, if the example said 10 million for the goods, the VAT payable 0% multiplied by 10 million. So, the VAT payable for export goods is 0 rupiah. The next example is taxable entrepreneur E uses taxable goods for his own company with a selling price 23 million. This price includes a profit 3 million. Like I said before, if we get the question like this, we have to know the real value first. The real value is 20 million. Why? Because 3 million is the profit. So VAT payable, same like the tariff before, 10% multiplied by 20 million, we get 2 million. So 2 million is VAT output tax for taxable entrepreneurs E. Alright, what will we do if a price includes VAT? So if a price or value includes VAT, at the first we have to find the DPP or tax imposition base by calculated 100 per 110 multiplied by selling price or replacement value. For example, taxable entrepreneur A sells taxable goods to agency at price 110 million. This price includes VAT. So the first we have to find the DPP by calculating 100 per 110 multiplied by 110 million is we get 10 million, and then we find for the VAT payable. Like I said before, the tariff for VAT payable or output tax is 10% for JKP and BKP. So 10% multiplied by 1 million. The value is 10 million. So the VAT of taxable entrepreneur A is 10 million for output tax. The last of our discussion is return of input tax and output tax. Tax invoice return is a term of tax invoice return which is done to correct the mistake of filling invoice data by the party receiving the invoice or buy. So this is the return because of the mistake. Let me see the example. For example, PT Associative in October 2018 submitted the BKP as follows. So the BKP is associative to PT Black Gold with a contract value of 385 million excluding VAT, to PT Sumber Rasa with a contract value of 715 million including VAT, that we have to underline excluding including VAT. And then the last to Koperasi Esa, which is not a BKP with a value of 275 including VAT. 275 million including VAT. Alright, the next problem is PT Associative reports the output VAT on the transaction in the June aspect. In July with details. First, PT Black Gold made a return with a value. This is the problem. Made a return with a value of 35 million and no replacement was met. There's no replacement for PT Black Gold. Then PT Sumber Rasa returned 5 million of the order and was replaced with a similar product. So PT Sumber Rasa was replaced with a similar product, returned 5%. Next, Koperasi Esa returned 1,500 of the order and doesn't replace it. So PT Esa doesn't replace it, the returns. Then, how to returns affect the VAT management of each PT? This is the answer. Return of input tax and output tax. First, the effect of return from PT Black Gold. So the second part is PT Black Gold. PT Black Gold reduced output VAT in the July period. For PT Black Gold, reduced input VAT in July by 10% multiplied by 35 million. We got 3,500,000. Next, the effect of returns of PT Sumber Rasa. For PT Associative or PT Sumber Rasa has no effect because it replaced by returns. Like I said before, PT Sumber Rasa, we got here, PT Sumber Rasa was replaced with a similar product. So we don't need the other return of input tax or output tax. Next, the effect of return from PT Koperasi Esa. For PT Asosiatif, reduce output VAT in July in Koperasi Esa by 100 per 100 ton multiplied by 1500 multiplied by 275 million. We got 3,750 million. Next, input tax returns and output tax returns. Return of input tax and output tax, of course, have the effect to the invoice returns. What the effects? First, reduce VAT on seller PKP output if previously reported. Next, calculated when return note is received. Third, takes into account when the return note is made. Last, reducing asset or ordinary if previously capitalized or imposed by non-PKP buyers.
I think that's all for our presentations.
We hope that what we explained will be useful for you.
Thank you for watching and cheerio!